The big question in this AI-driven bull market, now in year 4, is this still a starters-only rally where the mega caps do most of the work, or is the bench finally scoring? Relative strength is one of the cleanest ways to check that, and that's what we're digging into in today's Stocks in Translation. Now, relative strength is simple. You take one price and divide it by another price. Do that for each day's close in 2 different markets, and you'll get one line that goes up, goes down, or goes sideways over time. If it rises, the first market is outperforming. And when the line falls, that means that the second market is winning. Sideways is a tie. And once you get that, you can use it everywhere. So here are a few quick examples, all using different ETFs. You can divide consumer discretionary by consumer staples, XLY over XLP, for risk on versus defensive. Or look at the S&P 500 over the Russell 2000 for large cap versus small. High yield corporate bonds over US Treasuries for risky credit versus safe credit, and even gold versus silver to gauge a flight to safety versus an uptick in industrial demand. But today we're going to use this tool to see if this bull market is still being carried by just a few giant names or if it's finally broadening. And we're going to use here America's benchmark stock index, that would be the S&P 500, but taking 2 different calculations. So on top, we're going to use the market cap weighted version where bigger stocks get more votes. And we're going to divide that by the equal weighted version where each stock gets 1 vote. The result is that line you see. And when it goes up, the biggest stocks are doing more of the scoring. When it goes down, most of the or more of the index is participating using the bench. And this chart goes back to 1990, and you can really see the dot-com boom and peak right there. That was a peak concentration, and it was a steady decline into 2010 right here as the rally became much broader. Now look at the last few years that I'm circling here. It's been trending up again, which fits the Mag 7 dominant story. And we recently talked to Horizon's Chief Investment Officer, Scott Ladner, on Stocks in Translation. Here's how he framed it.
The past couple of 3 years has been all about the building of AI capabilities. That's where the Mag 7 really matters, and so they've outperformed. But these next couple of years are going to be about diffusing AI throughout the entire economy. Then the other 493, or the rest of the economy, the rest of the stocks can start to participate because they're going to start using this great tool for productivity enhancements.
Translation, the first phase was building the tools. A few companies did the heavy lifting. The next phase, using the tools, and that's what you can get more players on the scoreboard. Now let's zoom in because this is where the story turns into a real-time signal. And what we're showing here is the last decade. And you can see a slow rise into 2010 into 2020 when we had some wild swings over the pandemic. That's when leadership was changing wildly. And over the 2022 bear market, both indexes were going down. But the giants, the starters, they were sinking faster. So the line trended down until the AI bull market and the era of the Mag 7 was born. And that's what I'm circling right here. The line has risen sharply, and it hasn't been straight up. You can see some decent pullbacks when the mega caps stopped leading for a bit. But remember, this is about relative performance, one market versus the other. Here's Ladner again.
I'm certainly not calling for NVIDIA or Mag 7 or any of these big mega cap names to go down. All they have to do is just sort of tread water, or the other ones outperform.
And that's the whole game. You don't need a blow up in the starters, you just need the bench to contribute. So if you're watching for a broader rally in 2026, the question isn't only what NVIDIA and Tesla are going to do tomorrow, it's whether more of the S&P starts putting on points onto that board. So let's get one more actionable bite from Scott about what to expect in 2026.
Specifically within that 493, we like cyclical plays. Those are the types of industries and stocks that we tend to like right now because we do think we're going to get, at least for the first half of 2026, a really kind of run it hot type of scenario.
Run it hot. So keep an eye on the parts of the market that tend to benefit when growth picks up. Think industrials, retail, and banks. Bottom line, this ratio is your breadth scoreboard. If it flattens or falls, the rally is actually getting healthier. And if you change the ticker inputs, you can make your own custom scoreboard.
Well, markets have juggled a diplomatic tightrope this week, but let's not forget, also need to navigate earnings season now in full swing. Inez Frey now joins me for the Investor Playbook. Inez.
Yeah, Josh, and Wall Street is setting aside any geopolitical drama, and they are focusing on earnings, which is what really drives the market higher. And you have the estimates for the S&P 500 that are expected the earnings growth to come in at 8.2% for the fourth quarter. But FactSet analysts are saying that that could be over 14% when all is said and done, because over and over again, we're hearing about the fundamentals. Richard Saperstein, Chief Investment Officer at Treasury Partners, spoke to Julie Hyman and talked about the fundamentals. Take a listen.
When we look at the fundamentals, which is declining inflation, a robust economy, we've got excellent jobs. Jobs are moderating but growing, but we've got an excellent backdrop for earnings growth.
And BNY Wealth also had a roundtable this week, and I attended that. And they talked about the fact that you are going to be seeing a broadening of the market, and that you are going to see participation not just from the top 10 stocks, companies of the S&P 500, the Mag 7, but also from other sectors. And that's part of what we've seen also with the stock market year to date, when we've seen materials that are higher, industrial higher, energy higher. So you're looking at that cyclical play, and that is good because that means that it's not just the concentration when it comes to tech. But of course, strategists are enthusiastic about tech, about AI. That's still a driver of productivity. That's a driver of higher earnings for companies. And one other note to make as well is that the incentives of the Big Beautiful Bill, those are expected to really be seen this year, because those incentives for CapEx also, that's when all is said and done, expected to lower the tax rate for corporations by about 3%, according to some estimates. So that goes to the bottom line of a company as well. Josh?
So why did you guys keep buying, and why buy in a larger amount than you had been recently, especially as effectively your currency, that is your shares, have been going down?
Yeah, look, 2026 is going to be a big year for Bitcoin. It's going to be a big year for MSTR. And as a result, the best thing you can do as you go into a big year is to start to build a strong capital base. And that's what we've done really over the course of the last few years, but we accelerated the last 2 weeks. The other big thing about 2026 is it's going to be the coming out party for Stretch, which is our preferred equity. We launched it in the middle of last year. It's grown up to be over $3 billion this year. And we think building a strong capital base with Bitcoin, a strong US dollar base, all those things are going to bode well for what's going to happen with Stretch over the course of 2026.
So Stretch and your other preferred share products that are yield producing instruments, they pay out cash dividends. In order to pay out those dividends, Bitcoin price would be more helpful if it was going in an upward direction than in a downward. So how do you sustainably pay those dividends without either selling Bitcoin or continuing to issue new shares?
Yeah, so a few things that we've done, right? We've built up a Bitcoin balance of about $65 billion now. We've built up a US dollar reserve of $2.25 billion. And that allows us to pay the dividends out over the course of the next 60 to 100 years. So we have now duration in terms of Stretch. In the short term, what needs to happen is Bitcoin needs to go up about 1.5% a year for us to continue to pay our Stretch dividends. So it's not so much a concern about whether we can pay the Stretch dividends. The question we have is how quickly can we grow Stretch? And here we have, to your point, a product that is backed by Bitcoin, that is short duration money, that is low to very low volatility. Right now, we're at about 7% vol. Over the last couple of weeks, we've seen it go below 5% vol, and it pays 11% tax deferred dividends. So my concern is less paying the dividends, and how do we grow Stretch over the course of the next year? How do we market? How do we make sure everyone's aware that there's an option out there that gives people, whether you be low income, high income, low net worth, high net worth, you can get 11% on your money. And I think that's a unique feature that everyone is excited about.
Phong, have you guys turned so much towards Stretch because people aren't buying your actual equity at this point? I mean, as I mentioned, we've seen the big pullback. You're not trading at a premium to Bitcoin at this point. And there are more options than ever for people to invest in cryptocurrencies.
No, the reason we turn towards Stretch is we've been a levered Bitcoin company, right? And so if you think about leverage, what we've done over the course of the last 4 years, is we've raised capital primarily through convertible debt. Right? Convertible debt is an illiquid over-the-counter market that has large spreads and isn't perfectly priced. And so we said, instead of something that is an inferior product, let's go to a better form of leverage. We call it amplification. So our equity, MSTR, is primarily there to build a capital base. But really, it's our preferred product, Stretch, which is there to create leverage and amplification on the company. And so that's why we've been focusing on Stretch, not as an alternative to our equity, but as an alternative to debt instruments like convertible bonds, which are inferior.
Phong, I've been talking to you, I've been talking to Michael for a while now, and I have to admit, I still have problems sometimes wrapping my head around the business model, because setting aside the business software business that you guys have and focusing more on the digital asset treasury, none of this produces any cash flow, right? Either the selling of preferred shares or the convertible debt, you're buying Bitcoin. So I guess I still struggle at times to understand the long-term sustainability.
Yeah, we're a company that's built on the digital transformation of capital, right? If you think of capital and original sort of great store of value capital might be gold, we're a company that's built on digital gold, which is Bitcoin. So I'll start with that. And so when you find a asset that is both a technological revolution and a capital store of value revolution, you buy and hold it, right? Not much different than real estate in the 1900s or oil in the 1900s. Somebody finds an asset that they think is going to, that is truly revolutionary, and they buy and hold it. And so an analogy
but if you're going to use those analogies, in the case of oil, eventually you sell it at a profit, right? And in the case of real estate, it is a yield-producing asset. You rent it out and you get cash flow while you own it. That's not the case with Bitcoin.
Well, what we provide to our shareholders is Bitcoin yield, right? You get more Bitcoin per share of MSTR, right? And so that is the yield. And I know it's a bit of a mental exercise to understand what's the Bitcoin yield versus earnings per share versus yield on your real estate. But I don't think that that's much different, right? And can we get cash flow by selling the Bitcoin? We can, but that's not in the near term future. Right now, it's an accumulation play. And so how our shareholders think about our equity is, are we providing more Bitcoin per share? And we do that by raising capital.
I want to ask you about some of the pending debt obligations as well, because I know because of the structure of the company, you guys, the convertible bondholders, are expecting stock that is worth a certain amount. There is a rather large gap between what the stock is worth now and what they have been promised. So is strategy, once that comes due next year, going to have to come up with that cash to close that gap? And do you have that cash on hand? Do you have to raise that cash in some way? What's the plan?
Yeah, so we have convertible bonds that come due at the end of next year that have a strike price, I believe, in the low 200s. And then we have convertible bonds that come due in 2028 that have a strike price that are north of that. You've seen our stock has been fairly far north of the $200 amount. So the likely thing that'll happen is, as Bitcoin appreciates, we'll see our stock rise above that strike price next year and we'll equitize. If that doesn't happen, we have a couple of options. We could refinance the convertible and push forward the maturity at a future point in time, or we can just pay down the debt, right? And we could pay down the debt in one of multiple ways. We could issue equity, we could issue additional preferreds, or we could sell our Bitcoin. So I'm not too worried about the convertible bonds and their maturity that come due in 2027, 2028. These were long duration when we got into them. And Bitcoin price over time goes up. It's gone up 40% a year for the last 5 years. So
well, but there's
I
a
think
lot
we're in
of
a pretty good
it's gone
situation.
40% up a year, but there's a lot of volatility within that range, right? And so there's no way of knowing when that comes due if we're going to be at 90,000 or we're going to be at 40,000 or we're going to be at 150,000. There's literally no way of knowing. And you have to do sort of balance sheet planning based on an underlying asset that is extraordinarily volatile.
We do, which is why we have the convertibles paced out over time, right? They're laddered out. And if, first of all, I'm not sure that Bitcoin will go to 40,000, but if it does go down, we have a lot of options still, right? Like we have big picture perspective here. We have about $8 billion of convertible with a $65 billion asset base called Bitcoin and $2.25 billion of cash. Right, so this isn't like we're 2 or 3x levered and we have no way to be able to satisfy the debt obligation. We're in fact 10% leveraged. If you look at our convertible debt, or 15%. And so it's not really something that is going to break the company. It's something that, let's say Bitcoin was trading down at $40,000. It's something that will either push out the debt or we'll just pay it down.
And Fang, finally, you started out the conversation by saying this is going to be a big year for the company and for Bitcoin. I'm curious what you see as the next catalyst for Bitcoin prices, right? Because we've not seen them do much of anything so far this year.
Yeah, I think there's 2 major catalysts that I look forward to. I think greater government clarity, right, through our Market Structure Act, which will hopefully pass in the next few months. And there's a lot of discussion, a lot of great work happening at Capitol Hill related to that. And 2, which is linked to it, the traditional banking system, large banks who are sitting on the sidelines, who are working on technical projects, really ramping on either through the issuance of stable coins, the issuance of Bitcoin-backed lending, the issuance of, or the creation of Bitcoin custody and exchange services. I think all of those will really open up. And I think we'll sit here a year from now seeing that not just the US government, but governments around the world and the traditional banking system fully embracing Bitcoin and digital assets.
Talk to me about the timing of this IPO. You guys first out of the gate this year at a time when crypto prices are not doing a heck of a lot. The record of the companies that went public in your space last year kind of mixed here. So how did you guys think about when you wanted to come public?
Well, look, I think everybody that's in digital asset space is here for the long term. So kind of the ups and downs of where the market is a little bit less relevant to us. We actually started this process, last fall. We thought we were going to kind of get out onto the markets around October, but the government decided to take a little holiday, and so we ended up delayed out until January. But look, I think it's a good time. We've got a lot of business to be done. The fact that we're a public company now is bringing so many more potential clients to us. I mean, really, I think the last year with the regulatory changes, our total addressable market doubled, and then I think with this change, actually our TAM just doubled again.
So the TAM may be higher, but there's also a lot of people in this game, if you will. You guys offer custody, among other services. Coinbase offers custody, Fidelity Digital Assets offers custody, Gemini offers custody. There are a lot of players out there. So what is your pitch to investors about what your competitive moat is in that area?
Well, look, if there's one thing I can dispel right here, it's like, look, we're not a custodian. It's not like we had some grand plan to become just a custodian and that was the end game. No. It's a means to an end. We build infrastructure is what we do, and we build it at the highest compliance and security levels that anyone can ask for. So we're a brand you haven't heard of as much. We're kind of a brand behind the brand, so to speak, and that's because we focused on institutional demands. Now, by the way, we believe everybody on the planet, whether you're retail, whether you're institutional, deserves to have the same level of protection. You deserve to have a fiduciary that's overseeing your money, and we make sure that happens. You get it with your bank, you get it with your stockbroker, if you've got an RIA protecting your investments, all of those guys are fiduciaries. You come to us, you open up your account, you get a fiduciary account. Institutions out there demand this, and so we've always been providing it. We're just continuing to expand that. how we make our money is actually on the services on top, and that includes trading, that includes staking, borrow and lending services, collateral management, and then we also offer this thing called the Go Network, which is a settlement network which operates not just here in the United States, but across our 7 custodians that we have globally. So we've got a really large footprint, not just here, but also abroad. We connect that all together so that people can do digital assets everywhere.
And Mike, how closely is your revenue tied to the amount of assets on the platform? So in other words, if the price of crypto goes down and the value of the assets goes down, does that mean you're making less?
Yeah, look, I mean, some of our products are certainly correlated to the price of Bitcoin and digital assets. I mean, there's no denying that. But look, it's our job to build a business that hopefully is more resilient than just based on that price. So look, I'd like to have the numbers speak for themselves. Go check what we did in Q3, check Q4. It's all in the S1. You can analyze it yourself. I think in general, coming into the market right now, most people looked at Q4 last year. They said, hey, it was kind of a rough time for the tech sector, even a tougher time for the crypto sector. But I think if you look at BitGo's performance, I think it speaks for itself, and it was outperforming.
Well, if you look at the numbers for you guys, the 12 months ended September 2025. I think you guys had $164.7 or so million in net income, but that was lumpy, if you will, right? You saw a drop in the first half of 2025. And I know you guys have been investing to build. You're going to invest in the proceeds from this IPO to build. How exactly are you investing them? And then when do you expect to get to a more sort of sustainable profitability path?
Well, look, I think it's sustainable now, but look, we're a growth company. So look around what's going on with digital assets. Like what we just saw last year, the number of regulated firms that can now touch digital assets that couldn't before. Look at the announcements that are coming out in the market every day, whether it's the New York Stock Exchange's announcement this week, whether you're talking about companies moving to 24/7. All of these guys need digital. And as they move into the digital realm, they've got 2 options, right? Either they build it completely from scratch, and these are digital assets, right? So they are very different than anything we've ever seen before. Folks need help. So oftentimes they come and they turn around and they partner with us. So look, I know you can get sensitive about the price of Bitcoin being like the total barometer for how our company or our industry works, but as the base grows broader, that changes. Look, we are going to run this company responsibly. One last thing, I mean, BitGo's been around for 12 years, 13 years, and we've raised the least money of kind of anybody in the space. We raised about $200 million total, and we're profitable to this day. So we think the business works. I think also what you see in Q4 is that the EBITDA can start to creep up. So it is a business that will scale. But for right now, we're investing in growth locally and abroad and across multiple product lines.
Mike, something I'm really curious about, you control the majority of the voting power of the shares here, more than half, 55.5%. You own less than 8% of the economic interest. And that's not necessarily, on the face of it, unusual. We see those kinds of patterns in Silicon Valley. It's just more extreme than we usually see in terms of the gap. So you're effectively saying to potential shareholders here, trust me. Why should they trust you? What are you telling them?
Well, look at my history, but look at my pedigree. I think actually it's going to give a more consistent stewardship for the company. Obviously, the board of directors agrees as well. It's not just my decision that went into that. A little bit about me, I'm not actually from Wall Street, even though here I'm at the New York Stock Exchange today. I come from 30 years background in technology. Started my career at Hewlett-Packard, was at Netscape before that was a household name, did a number of startups. We are here to build and innovate. We build infrastructure, we're a brand behind the brands. We have to work with the utmost of brands. The fact that they're working with us today means that they've done their diligence, and hopefully that signals the right thing. Obviously my job, still deliver great value to shareholders.
Mike, thanks a lot for joining us. Appreciate it. And you sort of pinpoint 3 elements that economic growth this year will sort of pivot on, depending on how they stand. And the first of these really speaks to recent news flow. You talk about how aggressively the Trump administration pursues its tariff, immigration, and other deglobalization policies. Of course, that's been on center stage over the past few days in Davos. So what does that tell us about how that first one is going to work out and whether it is going to be supportive or not for growth?
Well, it's a headwind to growth. It's just a question of how strong that headwind is going to blow. I think it shaved almost a percentage point off of growth in calendar year 2025. And it's on track to do just about the same in 2026. I mean, a big wild card here, obviously, is the Supreme Court decision on the reciprocal tariffs. If they rule that those are unconstitutionally imposed, and the president has to eliminate them, that would reduce the headwind, assuming the president doesn't respond with other tariffs. But a lot of moving parts here. But at the end of the day, deglobalization, tariffs, immigration policy, export restrictions, investment controls, sanctions, visa limitations, all these things add up to a pretty significant headwind, and that will continue to blow hard, I think, in 26.
Well, and it's interesting, you also write in your piece, there's no quicker or more effective way to address the affordability concerns of voters than to lower tariffs. Obviously, that's not something that the president is super keen on doing. He's talked about doing other things to try to target affordability, some of the housing measures he's suggested, for example. Do those help at the margin, or does it really turn on tariffs?
Well, if you want to do anything this year on affordability, I think it'd have to be tariffs. Tariffs, the increase in tariffs in 25 added over half a percentage point to consumer price inflation. So if you want to get that inflation back down to something we can all feel comfortable with, closer to the Federal Reserve's 2% target, you'd have to get rid of those tariffs. But you're right, it doesn't feel like that's the direction the administration is headed. The other proposals, they're on the margin. I don't think they make a difference. Even if they, were implemented, they're not going to have an impact on affordability for quite some time. Certainly not this year in 2026. They play out over a long period of time. And all of them are on the margin. I mean, I know the housing ones pretty well because I spent a lot of time looking at the housing market.
Right.
They're all demand side measures, pretty much. Trying to juice up demand. But when the problem is you don't have enough supply, we don't have enough homes. The increase in demand will only make house prices go up more and just be very counterproductive in terms of affordability for first-time home buyers. So, I think if you wanted to address the housing affordability issues, you'd be focused on the supply side of the market, trying to incent more construction, more home building, rather than juicing up demand.
And Mark, I'm curious also about your focus on tariffs, given that economic growth has been largely okay, even given the tariffs. And there has been earnings growth as well has seemed to proceed pretty handily. So how are you thinking about the tariffs? I know you talked about what it's shaving off of economic growth, but if you look at the numbers in aggregate, I guess by and large they haven't been that bad.
Yeah, and that goes to you started the conversation with the three things driving growth. The headwind is deglobalization. One of the tailwinds is obviously artificial intelligence, AI, all the investment spending that's going on there. And of course, the surge in AI stock prices, which is running on its own dynamic independent of what's going on in the rest of the economy. That's driving a lot of increase in wealth, which is driving a lot of consumer spending by the well-to-do. So that's a tailwind to growth. And that was a significant tailwind in 2025. And by the way, Julia, I wasn't surprised by the headwind from deglobalization, but I was surprised to the degree to which we got the tailwind from AI, and that's going to continue to blow as well as in 2026. But let me make one other point. When you're looking at GDP, okay, it's okay, but if you really want to see the impact of deglobalization and tariffs, just take a look at the job market. I mean, just take a look at this graph, a picture of payroll employment. Look at it over the past couple of years, you could see it's steadily rising right up until Liberation Day, which was early April of last year. And since then, the economy has created no jobs, no net new jobs. It's completely flatlined. So that gives you a sense of the damage that the tariffs are doing. And for most Americans, by the way, Julie, it's not about GDP. It's not about earnings. What they care about is jobs. That's what they're focused on. They understand jobs. And that's why most Americans are pretty uncomfortable with the way things are going.
Well, and the AI elements is something that cuts both ways. I mean, I know it was a tailwind last year, could be a potential tailwind this year. I guess the question we're all asking is, what's the boost to productivity on the plus side versus how quickly it tips over into job loss or no hiring on the negative side?
Yeah, good point. So demand and supply. I mean, most of the juice from AI last year was demand driven. There was a bit of a pickup in productivity due to AI, but pretty much on the margin. This year, that could be different. We could see more productivity growth. I mean, history would say, if you look at the history of technologies like the internet as the most recent case study, that the benefits of the productivity gains, the earnings growth you talked about, the increase in stock values, that benefit diffuses throughout the economy, creates other jobs, and you see job losses over here because of the technology, but you see job gains over there because of the increase in wealth and incomes. And the net of that is the job market's just fine. I think that's probably what's going to happen in 2026 is going to play to a draw in terms of what it means for the job market. But that is a risk. I mean, if AI comes on more quickly and businesses adopt and implement it more rapidly and the productivity gains are more substantive and the economy doesn't have time to adjust to that, that could be a problem, right? Because the economy is already not creating any jobs. If that the AI boost productivity is so significant that it causes job loss, that could be a problem for 2026.
And then the third item that you're watching closely is stimulus, both monetary and fiscal. And I believe you actually think there are going to be more rate cuts this year than the market is pricing in. Is that because you are more pessimistic, perhaps, about the job market?
Yeah, that's exactly right. I mean, I think the Fed, obviously it's got a tough job here, right? Because of tariffs, immigration policy that slows growth, and it also raises inflation. So how does the Fed respond? But I think in my calculation, the headwinds are going to blow hard enough, the job market's going to be weak enough that, and inflation less of an issue, that they will cut more in 2026. There's a lot of, is it 1 quarter point cut? Is it 2? Is it 3? That's a reasonable debate. I expect 3. That's what I have in my expectations in my forecast. But I don't think I'd argue with anyone too strongly if they said 2 or 1 or 4. Something in that ballpark.
Mark, I want to turn to the research that you at Moody's did on the so-called K-shaped economy. And your latest analysis, 59% of all consumer spending comes from the top 20% of income earners. Listen, you've been doing this for a long time. I've been doing this for a long time. Something about right now feels different in that way in the United States. And I'm just wondering sort of how you're thinking about it more broadly, because normally this happens, the market's doing okay, the GDP's okay, even if folks at the bottom are not doing great. Is that different this time, or does it feel different than in past eras to you?
Yeah, isn't that an amazing statistic, though, Julie?
Yes.
I mean, the top 20% of the income distribution counts for 60% of the spending. That's just, and it gets even more crazy when you go further up the distribution. The top 10%, the top 1%, the top 1/10 of 1%. I mean, very concentrated, and it's become increasingly so. And I don't know that's a cliff event for the economy. I don't think that, but it's definitely a corrosive, and it's certainly a vulnerability, right? I mean, if our economy is so dependent on the well-to-do, and the well-to-do are obviously so dependent on the stock market, and the stock market is obviously very dependent on those AI stocks. I don't know. That doesn't feel like a really great place. That goes to my point about fragility. That feels fragile to me. That doesn't feel anything other than that. That's a potential threat. The other thing is, this makes it feel a little different. I do worry about AI in this context. I mean, it does, past technologies, remember we talked about how the benefits of that diffused out throughout the economy and benefited everybody pretty quickly. This feels like it might not be. It feels more concentrated. The companies that are dominating, they're hyperscalers, are huge, they're massive in any scale economies, and their shareholders are benefiting enormously. Are we going to see the benefits of this diffuse more broadly? And if we don't, then the income and wealth distribution, the spending distribution is going to become more skewed. And I think that has all kinds of things we need to worry about longer run. What does it mean for our politics, our fractured politics? Can we come to a consensus on anything if we've got all these different, very widely different perspectives and performances across the income and wealth distribution? What does it mean for society, our societal ills, everything from drug abuse to homelessness and everything else? So I do worry about this, and I do think it's an issue. I don't think it's a near-term threat, but I think it's a longer-term problem that we're going to have to grapple with.
Consumer products giant Procter and Gamble is out with better than expected results. Guidance more in focus, though, as consumers in the U.S. battle through affordability challenges down the supermarket shopping aisles. I caught up with P&G CFO Andre Schulten on all this.
I would characterize quarter two as a quarter that sets us up for growth in the second half of the year. Why do I say that? The business outside of the U.S. Is growing 3%, so growing actually very well. We have Latin America growing at 8%, China growing at 3%, Europe in aggregate growing at 3%. Our Asia, Middle East, Africa region is growing at 2%. So you see the growth outside of the US is consistent and broad-based, with all of the innovation, all of the interventions on the commercial side, all of the interventions on the go-to-market side that we started about 12 months ago are taking hold and delivering as we expected. The US is a bit unique in the quarter that we just completed. We had a significant inventory build in the base year. So about a year ago, we had 2 port strikes and a hurricane in the US, which led retailers to build significant inventory, specifically on our household care business, and consumers built pantry inventory. So those led to a weaker shipment quarter in the US, and in aggregate to the result that you see for the quarter. The exciting part is the innovation plans and the commercial plans that we have started to execute in the US and that we are executing across half two have the same characteristics as the plans that have led to growth outside of the US. So we're very confident that they will also lead to an inflection on the US business. And again, if you take the base effect of the inventory loading out of the quarter, we would have already have seen growth. So this is now a matter of time to emerge in the second half. There are always things that can negatively affect the business. So we keep our guidance range, both on the top line and the bottom line, but we're confident that we're on the right path.
Ajay, within your outlook for the year, again, reaffirm that those top and bottom line outlooks. How important is it that the U.S. starts to turn the corner, that U.S. shopper that has been worried about affordability when they go to the grocery stores, how important is that consumer to you delivering on your outlook?
I would say that the underlying consumption that we see of P&G categories has to sustain. If you take out the pantry loading, over the last 3 months, the P&G consumption would have been about 1.5% to 2% in terms of value. So at a minimum, we expect that consumption to sustain. If we are successful in the execution of our commercial plans and all the innovation we're launching in the second half in the US, we feel pretty good that we're going to be able to do that and hopefully a little bit better. So that's an important part of the guidance range. The other part of the guidance range is that we obviously want to sustain the momentum that we have created outside of the US. But the range we have communicated at the beginning of the year is fairly wide, given the volatility and given all the unknowns that we see around the global business. But the US is important, not a material step change in terms of underlying consumption, but sustained momentum outside of the US. Both components would lead to a good outcome for the fiscal.
Consumer products companies have been taking some heat recently, Andre, on just continuing to shrink the sizes of what they sell and raise the prices. What do you say to that?
I say the categories we are in are daily use categories, and performance is very important to the consumer. If you do your laundry, you want your laundry to come out clean and smell nice the first time. If you use a diaper, you want the diaper to work overnight and not cause every skin irritation. So the products we sell are used frequently, and the performance of the product is very important to the consumer. And the consumer is a very diligent judge of value. And value in our categories really is defined as the product performance, the packaging execution, how well we communicate the performance, and how we execute that in store and online, relative to the price that we're asking the consumer to pay. If that balance is right, we see the consumer choose P&G brands, and we see the consumer even trading up within the P&G portfolio because they like the promise we make on better performance, they trust the brands, and they trade up to a higher order proposition. The other element I would tell you is critically important for us to offer the consumer choice. So we offer choices in terms of different tiers. If you want the super premium diaper, we have Swaddlers. If you want the mid-tier diaper, we have Baby Dry. If you want a value diaper that is closer to private label pricing, we have Loves. And we need to be competitive versus the next best competitive offer in all of those in terms of value. And again, performance relevant for the consumer relative to the price we pay. So my simple answer is I think the consumer is a diligent judge of value. So it's our job to keep that equation in equilibrium. That's why we start every conversation with the consumer at the center. Are we delivering truly irresistible superiority, relevant for the consumer, and value is a part of that superiority?
Andre, I don't know if you're following the World Economic Forum in Davos. We're getting a lot of interesting headlines on the state of the U.S. economy. President Trump saying that he thinks the economy is growing 4 to 5%, can continue at that growth rate. NVIDIA CEO Jensen Huang saying 6-figure jobs are being created from AI data centers. When you study the U.S. consumer and the health of that shopper, is the consumer as strong right now as some of those numbers or some of those headlines would suggest?
Well, those headlines are certainly exciting. What we're seeing and observing is growth in our categories in the US and outside of the US, albeit at a slower pace. So if you look at our categories, they have grown in the past 3 months in the US somewhere between 1% and 2% in terms of value growth, more flattish in terms of volume growth, which is about consistent with what we're seeing in Europe. And is slower than what I would characterize as the typical growth rate that we see in our categories, which is more in the range of 3 to 4%. Part of that is base period, but part of that is just slower consumption, and the consumer is choosing to be a little bit more diligent in terms of using up pantry inventory, maybe dosing the product a little bit more carefully. Maybe making choices in terms of how frequently they use. None of this is untypical. None of this will sustain. So we firmly believe the category over time will return to 3 to 4% growth. And we view it as our job, Brian, to help lead that turnaround in terms of category growth acceleration, because in many of these categories, we are the market leader. So bringing in new innovation, bringing in excitement to the category, bringing in better performing products, better communicated promises of performance, all of that is our way to initiate category growth. So not strongly growing, more 1 to 2% now, but our job is to return it to 3 to 4%, and typically that would happen over time.
You're also maintaining your expectation on how much tariffs will impact the business this year, about $400 million. And I think you offer an interesting perspective on this, given where have you spent a lot of your career. A lot of focus now between renewed geopolitical tensions between the U.S. and Europe. Have you crunched the numbers on what fresh tariffs on Europe would mean to a business like P&G, and how much of a hit would it be?
Yeah, our tariff exposure came down from the beginning of the year, where it was about $1 billion, to about $400 million after tax now. The P&G team has done I think, fantastic job in dealing with those tariff exposures via strong productivity work, sourcing changes, formulation changes where necessary and possible. And then the remaining exposure was offset with innovation-based pricing, which we typically do every year. We treat tariffs like we treat commodity or foreign exchange rate. We tend not to speculate and run the numbers before we have the facts. So I really don't have a good answer for you. I apologize. But in any case, wherever foreign exchange rate goes, wherever commodities go, wherever tariffs will go, it'll be the playbook for us, the same playbook for us, Brian. Productivity, sourcing formulation changes where possible, innovation and pricing. That's the combination. And to our earlier conversation, carefully respecting consumer value in the process.
I thought one of the most interesting things he talked about in the speech that he gave in Davos were not one of the most interesting things about the Fed specifically. He said, the problem is you interview these guys, they say what you want to hear, and then you appoint them to the position and they do what they want. And I don't know what we take away from that in terms of giving us any clues. What did you think?
Yeah, he clearly has expressed this kind of sentiment repeatedly about Powell, that he got, advice from his then economic team to pick Powell and everything went great. And then as soon as he got in there, he started making decisions that the president was not so fond of. And given that that's still his mindset, it makes it a little hard for me to picture Reader being the pick. Respected guy. But if you're worried about this notion that, just like in the first term, you're going to rely on the endorsement of your senior economic staff to pick this respected person that you don't have a very deep relationship with, and then have to count on them kind of doing what you want them to do. That doesn't paint a very reassuring picture from Trump's perspective, in my mind, for picking Reader. And for precisely the same reason, I don't think that Hassett is out of the running. I mean, the comment he made about wanting Hassett at NEC rather than the Fed seemed offhanded. It was a little bit of a quip in my mind about how much he values him where he is, a statement of appreciation more than like a firm public pronouncement that he's definitely not still in consideration.
Yeah. So it sounds like though Warsh also in your mind might still be in the running too?
Yeah, absolutely. I think either Kevin's very easy to imagine, but beyond that set, I do still have a hard time picturing Reader or Waller for similar reasons. Warsh, the hawkishness remains a little bit of a curiosity in terms of like why it is that he's gotten such consideration from the president, but the president sure does seem to like him despite his career-long hawkishness on balance sheet issues in particular. I think that the positions that Warsh has articulated don't really line up with President Trump's goals perfectly in terms of what he wants to see from the Fed, but he's been clearly in consideration the entire time despite that.
Tobin, switching gears, let's talk about what's been occurring in Davos elsewhere. Obviously, we heard the president talk about Greenland as well, but also getting a lot of attention was a speech by Canadian Prime Minister Mark Carney, where he talked about the rupture of the international rules-based order, and he talked about the implications for what he called a middle power like Canada. I'm curious, putting that together with the president's speech, kind of what the implications are and what investors need to pay attention to.
Yeah, I think a lot of countries are looking at the kinds of moves that have been made recently and figuring it seems like we're in a bit of a might makes right world where they can't really rely on predictability based on the old rules that used to apply from the United States. And so I think that clearly was a consideration in Canada striking this deal with China, trying to find alternative export markets if they're not going to be able to rely on the U.S. They don't know how the USMCA negotiations are going to go this year, which is, I think an unfortunate consequence of the policy that we've been pursuing here in the U.S. There's been lots of talk at various points about how really the purpose of a lot of what's being done is to create a united front against China. There's been a lot of talk about a fortress North America where, we get Canada and Mexico to erect shared walls against Chinese investment and imports to make a more deeply sort of interwoven economic zone here in North America. And this, of course, is not that. So, from an investment perspective, I don't, a lot of the geopolitical stuff, as always, is sort of noise that's going on that markets, like to look through when they can. We, of course, saw a big sell-off on Tuesday on the Greenland news, but we're largely reversed that now that we've sort of ruled out the really, really bad downside consequences. But, the main event from a U.S.-Canada perspective will be the USMCA renegotiation with what's understood to be a deadline this year, although it's not a particularly binding deadline. And, if something goes sideways, then the auto industry, most of all, I think, has exposure to potential risks there. But we do think that that'll get extended in some form.
I mean, last year, to some extent, was a story of diminishing impacts on the market from Trump risks, right? Sort of from Liberation Day on forward. And this year, it felt like we sort of forgot for a second, and then we were reminded. But do you think it'll be a similar pattern where you get these sort of little shocks, but there's maybe diminishing market impact as the year goes on?
Yeah, I think that's probably right. But honestly, even more so in some of the single name shocks than in the kind of big picture macro geopolitical shocks, we are still seeing people not looking through this in terms of actual pricing. So the 10% credit card rate cap that President Trump announced, he'd initially said he was doing it unilaterally. He said banks were going to be in violation of an unspecified law if they were not in compliance by January 20th. We're now past January 20th. Nothing has happened. And in his Davos remarks yesterday, he called on Congress to take action there, basically admitting that he can't do it himself. And yet, some of the companies with the most obvious exposure to that, companies like Capital One, are still substantially off. They have not rebounded fully from the sell-off that we saw on that news in the first place. So it's possible that that needs to be sort of relearned in new contexts by market participants, that we sort of saw what the tariff, taco playbook looks like. People need to get their head around what the playbook looks like on some of these more sector-specific and company-specific threats.
Tobin, as somebody who tracks DC so closely, is there any chance that the president will get buy-in from Congress and be able to pass a credit card cap or the ban on institutions buying single-family homes, for example?
Yeah, the credit card rate cap, I think, is essentially 0% chance. That is not happening. There's been a lot of very, very overt skepticism about that from Republicans in Congress, and it's the concerns about unintended consequences are very real. It would genuinely be a very bad outcome if they did that in terms of consumer access to credit. Some of the other things he's called for, the restrictions on institutional investor ownership of single-family rentals, or the Credit Card Competition Act, which goes after Visa and MasterCard, essentially forcing competition in terms of payment networks. Those are, I think, still not odds on, but they could happen. I personally am fairly skeptical that either of those will get done, but it's not inconceivable the same way that the 10% credit card rate cap is.
There's been a lot of focus on geopolitics this week. We've seen the swings in the market. How do you handle that as somebody who is managing money?
Well, within the framework of a three-tiered analysis of fundamentals, Fed, and geopolitics, the geopolitics is the wild card this year. Obviously, POTUS is going to have a lot of self-inflicted wounds on the market, yet we have to look back to last April when we had Liberation Day. And as I said, it's self-inflicted, so they'll naturally cure themselves. So what we're doing...
So is this taco by another name? Is what you're talking about? Trump always chickens out, that the market reacts and then he backs off?
I think I think as an investor, we have to look at the other two fundamentals I mentioned, which is the economic landscape, which is very positive, the Fed, which will be very accommodative. And then when we look at this last one, creating the volatility, it's creating buying opportunities as a result of the other two being very positive.
Gotcha. So in other words, you think the fundamental backdrop is positive and you're not worried that this volatility will spill over into fundamental. It's just going to sort of be surface market volatility?
No, it's very separated and segregated. When we look at the fundamentals, which is declining inflation, a robust economy, we've got excellent jobs. Jobs are moderating but growing, but we've got an excellent backdrop for earnings growth. And we've had 12 quarters of successive earnings growth. I think we continue with that. And as you know, stock prices follow earnings.
Right.
So from that perspective, the landscape is very positive. When we look at the Fed, it's going to be accommodative. Obviously, we're going to have a new Fed chair. So when we combine the fundamentals of the economy, the Fed, and the geopolitical scene, which will be filled with these self-inflicted wounds, they present an opportunity because the backdrop of investing today is very good.
And so where are you looking right now? And has where you're looking changed in 2026 from 2025?
The playbook is about maintaining and then considering some broadening out of the market. So maintaining is our core positions in large cap technology, the AI universe. That trend is really one of the main ones driving the economy. For example, high net worth spending and the AI tailwinds is actually driving economic activity now. So we want to stay with that. We want to avoid the selective capitalism being handed out by POTUS. For example, whether it's credit card companies or institutional home owners.
Right, but how do you know where that's going to land next is the problem. So you avoid it when it happens, but that's by sort of definition being reactive then instead of proactive.
Yeah, I'm not sure I'd be buying those names after they go down.
Right.
But I try to avoid what is a known.
Mm-hmm.
Obviously, we don't know what's coming up next. Areas of opportunity on the broadening out theme will be in consumer goods, banks, other areas where they rotate away from the AI and technology trade.
Interesting. So you want to own the AI and technology trade, but at the same time, you want to get into some of those broadening areas. Do they have to be integrating AI, or it's separate entirely from that theme?
Well, I think that's the theme that's going to occur over the next few years, where many industry groups will continue to integrate, embrace, and become more efficient by adopting AI. And the primary outcome will be higher margins, and we'll also see greater efficiencies in their operations. So that margin improvement will lead to greater operating cash flow and hence free cash flow. So AI adoption is going to be a long-term process for corporate America, which will ultimately benefit earnings.